Well, the second quarter got done last week and the key takeaways are a bit confusing. I'm saying that because some brokerages like CLSE and Jefferies have cut their Nifty EPS forecasts for the full year by a minor 3 to 4%. But Motilal Oswal has upped their Nifty earnings forecast by about 2.5%. To understand more about the key takeaways from the Q2 numbers and what do we make sense for the rest of FY23 in terms of what to expect in terms of earnings performance, I have with me Gautam Duggad, the head of Equity Research and Institutional Equities at Motilal Oswal Financial Services. Gautam, thank you very much indeed for joining us. Let me begin with this. The overall impact we got from the Q2 earnings from a couple of these brokerages is that they've lowered their earnings forecast for the full year after looking at Q2. You've chosen to up it. What was your key takeaway from Q2?
Hi, Lata. Good morning. Thanks for having me. So actually, Q2 went slightly better than what we had anticipated. And there are a couple of factors which drove it. For example, we were expecting Nifty earnings to stay flat for the quarter. Actual performance was better and it grew by about 9%. Right. Secondly, excluding the commodities, because commodities had a huge drag, global commodities. If you look at performance excluding metals and oil and gas, the earnings growth was about 33% for Nifty. We were expecting about 27-28%. Obviously, financials have been a big catalyst for such a strong performance. And at the same time, global commodities were a big drag. What also helped at the margin was the government's support for OMCs, which that 22,000 crores of largesse where they provided for some of those losses in LPG. So that essentially meant that oil and gas universe, where we were expecting profits to decline by 90%, has actually seen a 30% decline. So combination of some of these factors resulted in a minor 2.5% earnings upgrade for Nifty for us from 817 rupees to 837 rupees for FY23, which now translate into about 14% growth. And which are the companies which drove that big upgrade of 2.5%? SBI, Axis, Coal India, and some of the consumer names like Titan and Britannia, which posted very strong set of numbers. They helped the earnings move upward, while some of the global cyclicals like Tata Motors, they pulled the earnings down. We saw downgrades even in names like Asian Paints, VPs, and minor downgrade even in Reliance. So all of that put together essentially translates into about 2.5% earnings upgrade for FY23 and a growth projection of 14% for FY23 for Nifty.
Okay, you're standing at 14%. I think the street consensus is between 10 and 11%. I don't know if you have compared, but where are you more optimistic?
I haven't had the chance to compare, Lata. Generally, I don't compare. So where we are more optimistic possibly is on financials, where we are seeing for the next 2 years, for our coverage universe, not just Nifty, where financial earnings are expected to post a 31% earnings CAGR. As far as Nifty is concerned, we are well aware that profits are already up 35% CAGR on a 5-year basis. We have seen upgrade in financials for this quarter by about 2 to 3%. So now we are expecting financials alone as a pack in Nifty to do a profit of roughly 2.05 trillion rupees, which last year FY22 was 1.5 trillion. So around 30% growth in FY23 for Nifty financials itself. And by the way, this is no longer coming on a low base now, because the last 4 years already, we have seen profits move from 60,000 crores in FY19 to 1.5 lakh crores in FY22, which we are expecting it to cross 2.05 this year and then 2.4 trillion in FY24. Okay. And then in terms of other sectors, if I look at Nifty alone for FY23, financials account for 63% of incremental profits. If I add up auto and IT, it basically accounts for 90% of my total incremental profits in FY23 over FY22. The rest of the sectors are not doing much.
Okay. Do you still have buys on banks? Your overall stance is that the market is fairly well priced. I will come to that in just a minute. But only with respect to financials and autos, I think you have an overweight even on that. Do you still think that there is headroom for the prices to rise?
Absolutely, Lata, we do think so, and which is why we have a big overweight on financials now for third year running. And numbers speak for themselves, right? We have seen top-notch performances from both set of banks, public sector as well as private sector. Whether it is credit growth, whether it is margins, asset quality, some of the PSU banks have crossed ROA of 1% and ROEs of 15-16%. I don't recall when was the last time we saw that. And I think this is just the beginning of a new cycle where we have seen good performance for the last 3-4 quarters. I would think this performance to continue for at least another year or two before we start getting worried about the excesses of the new cycle. Secondly, if you look at the underwriting quality also, and if you look at parameters like risk-weighted assets and so much other granular details, we'll find that quality of lending in this cycle is slightly better than what we've been used to. So, and of course, all of this, when you look at valuations for the pack, valuations are not cheap anymore, but at the same time, they're not exorbitantly expensive either. And in a market which is struggling on so many fronts, global geopolitics, central bankers, this is one segment which is still offering you the comfort of earnings visibility. So it's quite natural to stay over it there.
Okay. Now, I take your point. We had even a former RBI deputy governor who supervises these banks saying that, institutions like the CRILIC, institutions like even CIBIL, which collect data, all are much more capable now than they were before. And hence, all of them are getting perhaps their game right in the days to come.
Yeah,
so you would go for a higher price to book for the public sector banks as well. Until now, we used to give a 3 and a 4 price to book only for the top grade private banks. The public sector banks usually traded at even lower than 1 price to book. Do you think the bigger rally to catch up is in that segment, the mid-caps public sector banks?
No, Lata. So it's easy to get carried away when the cycle is in your favor. If you look at the history of PSU banks on valuations, generally in good cycle when the performance is good, you see price to book crossing 1, and someone like SBI may trade at 1.5 to 1.8 times, depending on where you are in that cycle. So if you look at the performance right now, PSU banks have clearly outperformed the private banks for the last trailing 12 and 18 months. We have single largest overweight on PSU banks in our model portfolio versus the index benchmark of 2.5%. Our model portfolio weight for PSU bank has been 7% for last 12 months now, within which SBI is 4.5%, and Bank of Baroda, which we had added in April, is at about 2.5%. But one has to always remain cognizant of the PSU bank trend, because generally you've seen that consistency has been lacking in the past couple of years. So this is a segment where you have to move quarter to quarter, because this is not a long-term investment. This is a cyclical or within a cyclical sector. And once you see valuations are crossing 1-time price to book, because ex of SBI, most of the PSU banks are still trading below book. So then that is the time where you need to get a bit more cautious. Right now, our preference is with SBI and BOB. And I know that the rest of the banks have also performed quite well during the quarter, whether it's Union Bank or Canara Bank or sundry other PSU banks. They posted good performance. But from our point of view, as per as our limited model portfolio construct is concerned, we have SBI and BOB, and we are comfortable with that as of now.
Okay. Gautam, yeah, financials, the argument is taken, and as you say, it is quite a chorus, and one can get taken away. Your overall view on the market, however, is more cautious. Can you explain that?
Yeah, so the view has not changed in the last 12 months. In fact, if I look back, when we were doing the outlook for 2022, we had the same view that markets had overrun and earnings need to catch up. And therefore, it will be good if we get a flat market for a year, which we actually got, but interspersed with a lot of volatility in the interim. First, we went down 15% from Jan to May, and then from May to November, we've recouped all the losses and marginally up for the year. Net-net, we have been flat for 2022. I would think that if we can spend some more time in this range for another 6 to 9 months, then valuations will look slightly better, because earnings will have a time to catch up with those valuations. Right now, you're trading at 20 times 1 year forward, which is neither too expensive and certainly not cheap, because this is the long period average, 19.6, 19.8 for 10 year, 15 year. So valuations today do not provide you a much room for execution error. And that is why it pays to be a bit more cautious here, because in the interim, we have also seen interest rates go up by about 200 basis point roughly, and maybe they have a room to go up by another 75 to 100 basis point. So that will definitely act as a headwind for equity valuations. And when you look at individual sector, because index tends to hide a lot of things when you compare valuations, individual sector by sector, when you compare, there are a lot of risks which are emerging. So it pays to be cautious, and will be good if we do not fall much, because that is what has been the story for the last 12, 15 months. While the rest of the world has fallen 20, 25%, we've been flattish and outperformed.
1 minute, Gautam, when you keep seeing 10 and 15-year long period average, you are not including the 2004 to 2008 period, right? The averages are from 2008. So if we are repeating the 2004 period, we can be better than the 15-year average.
See, actually, a lot of these things, they make only statistical impressions, because what has also happened in the interim, if you look at the last 10 years, just the index composition, your index composition has significantly changed. If you look at only the Nifty from 2012 to 2022, a lot of the sectors which used to have 5 to 8% weightage in the index back then, like capital goods and telecom and real estate, cement, all the high beta infrastructure-oriented sectors, cyclical sectors, those sectors have lost their weight in the index. And what has happened in the interim is the weight of sectors like consumer, IT, financials has gone up significantly. Now, these are sectors with slightly better earnings visibility, higher ROEs, and higher payouts. So when you compare index averages today on a 10-year and a 15-year basis, it gives you a slightly misleading picture, because what you are comparing has changed. But for want of other such matrices, we take the easy path and keep comparing it. So yeah, when you look at 15-year average, it is from 2007 to 2022. It doesn't include that 2004 period that you're talking about.
Yeah.
Because at the beginning of 2003 itself, the index was trading at 10p.
Okay.
And Sensex, I think, was
no,
about
I've bought your argument. I take your point. Let me, running out of time. Now, even if you're hands-off on the market or cautious about the overall market, what would you still buy? Other than banks. I mean, I know that argument is convincing.
So second piece that we like is IT, large cap. We see value in that. And now everybody is aware about slowdown in US and Europe. We have seen that 3 quarters now, that narrative. None of the IT companies, by the way, has come out and reduced their guidance. On the contrary, we have seen guidance being upgraded by 2 or 3 companies. At the margin, supply situation is easing for them. So therefore, the margin pressures will mitigate to an extent. So that is one segment where valuations have corrected 25 to 30% on a trailing 12-month basis. We think it offers value. Second, one of the ignored part of the market for the last 3-4 years has been consumer staples. And I think with the election cycle coming for state as well as the major one, 2024, government spending in some of these segments, which are more rural oriented, should pick up. And given their huge underperformance, I think it is a good trade to have on consumer staple side. Aside of this, our usual preference for consumer discretionary names like Titan, Jubilant FoodWorks, Metro, that continues. And then, of course, we like auto. Selectively, we like telecom, cement, capital goods. And we are underweight on energy, utilities, and, of course, metals.
Got that. Gautam, out of time. Thank you very much for an extremely useful conversation. Overall, market valuations are a bit of a deterrent for a buyer. But within that, banks, consumer discretionaries, consumer staples still afford a lot of buying opportunity, and even good old IT. Wrap up on Bazaar, trading ideas lined up for you on Chartbusters.